Cookie, g'day, mate. A big meeting coming up next week. Very big meeting. And the markets are saying pretty much 100% probability of an interest rate decrease. They're talking 25 basis points. You, Stephen Koukoulas, has actually been out there throwing out the 50 basis points a few times. Maybe just sort of tickling the market a bit on X. I mean, Stephen Koukoulas on X. What's going on out there? What's changing? Where do you see it all sort of developing? Like what are the developments? What's the momentum? We'll leave money markets out of it for the moment, and we'll leave out what the banks are saying at the moment, and we'll leave out what all the other experts out there are saying at the moment. But what are you thinking? What are you feeling and hearing?
You're quite right. I am poking the bear a little bit with that call.
Well, you do that on X. I know you do it on purpose.
It's more to generate a conversation because I get frustrated in economics about a narrow consensus that doesn't question where we are. So I'll take a step back. We know that there is an interest rate that is what we call neutral, that doesn't add or subtract to a functioning economy. And that's about 3 to 3.25%. We can't pinpoint it any more closely than that.
As an official rate. As
an official cash rate. If and when interest rates are at that level, it's at that what we might call the Goldilocks. Not too hot, not too cold, just right. When the economy is strong or we have high inflation, interest rates go above that level to scale back the economy. When the economy is weak, they go below that to stimulate borrowing, spending.
So right now you would say the current cash rate is
restrictive.
Yes.
We're at 3.85% on the official rate. Let's just call it 50 basis points above neutral. Okay? Now
the Reserve Bank also endorses that.
They do, correct.
They also say we still believe that the current cash rate, official rate, is restrictive.
Correct. So we've had the RBA governor, we've had Sarah Hunter, who's sort of the chief economist. I think her official title is assistant governor. We've had them coming out in the last month or two or three saying that rates are still restrictive. Yes, and I think everybody I've heard agrees with that. Now, you have, as I said, you have rates that restrictive when you've got high inflation or an overheating economy. Now, the economy is not overheating.
Definitely.
Definitely not. GDP growth, which came out a little while ago now, sort of a little bit like ancient history, was weak. And we've had things like retail spending, building approvals, consumer sentiment. They're all pretty soft.
Yeah. So
okay?
we
don't have an overheated economy.
Just on GDP though, for our audience, just to remind us of something. So the annualized GDP is 1.2 around that.
1.3.
1.3. Okay, which is considered to be weak. That is GDP growth from 1 year period to another 1 year period has only grown by 1.3% relative to the previous period, and GDP being the usual measurement. But in addition to that, the last quarterly GDP growth was
0.2.
0.2, like it's not very
0.2.
good. So that means
below the population. So that's why per capita,
we're in a recession. We're
going backwards. Correct.
We're
going backwards.
We're negative.
Correct.
But we just leave the per capita bit out at the moment because it's
complex.
I don't know whether you should or you shouldn't do that, but if we just look at the number, it's 0.2. Which, by the way, even if you extrapolate that out, for 1 year, we're talking about 0.8,
less than 1%. Yes,
less than 1%. Which
the economy
is pretty
ain't
pathetic.
Strong. In fact, it's weak,
and relative to other countries, very average
compared to the US. Although they've got a bit of volatility with the Trump tariffs and the big budget bill and all this other stuff.
Big beautiful bill,
whatever it's got, a couple of straight like BBB. Their economy's doing better than ours. New Zealand's recovering. They did have a recession last year, but they've recovered. They've had RBNZ, New Zealand Central Bank, cutting rates
aggressively,
really aggressively. Yes. So we are not performing as we should. It's a bit like your old school reports. Doing okay, but could be doing better. So
that means the economy, and you know what that usually meant?
Okay.
You know what's funny about that?
Yeah.
That usually meant that you were not paying attention,
and you weren't functioning at your potential.
Correct.
Because you're goofing off, looking at the footy, and doing.
And I actually feel, I'll be honest with you,
that was my school report, Mark.
I actually feel, though, Steve, that our government, and I won't use the word guilty, but is sort of participating in that.
Yeah.
I just think they're goofing, maybe not goofing off, but not paying attention.
Not acting fast enough.
And not paying attention. I just don't think there's enough attention paid to what's going on out there because they're not experiencing it like a business owner might be.
I'll take two steps back. One is that this productivity summit that Treasurer Jim Chalmers has got coming up.
August, yeah.
In August, so it's still a little way away. Look, fair enough, but I can sit here and tell you what will the results be. We know it. We know what the productivity issues are. It is the tax system. It is red tape. It is skills education and training. I was at a builders function last week, I think it was, and even though the labour market's a little bit softer, they can't find the tradies they need to build a house.
And therefore, cost of building is much more expensive.
And so therefore, if I do need that electrician, that bricklayer, the machine operator, whatever the hell it is, I've got to pay up, which is eating my margin.
Because they're not stupid. They'll say, well, hang on, I'm so busy I can't get there.
So we know what productivity is about. Skills, tax, all these sort of things. Just do it. It's like the good old Nike tick, just do it.
Yeah.
We know what the result's going to be. And okay, there are going to be policy decisions to boost productivity that might not be popular. You're going to crack a few heads when you're changing the rules and regulations. But I look back at, you know me, Mark, I'm a huge fan of Paul Keating and even Peter Costello in his heyday, introduced the GST, introduced the Future Fund, the Sovereign Wealth Fund, did a whole lot of stuff that I think, yeah, that's good. Keating, reforming the banking sector, all this sort of stuff, opened it to competition, floated the dollar. Great.
Reform superannuation. And right now, he's going nuts about what they're proposing to do with superannuation. Well, fair enough.
Yeah, fair enough too. So there's a whole lot of things that those reformers did 20 to 30 years ago, gosh, that's a long time ago, that we are benefiting from today. We need that next increment of, okay, take a deep breath. Australia's doing okay, but if we don't change these issues, it won't be long before we are not doing okay.
And as Chris Joyce said, we're the Ibiza economy.
I don't buy that.
But it's more of the point that he's trying to make.
I think and good on Chris, using colourful language to make a point. No, good on him. No,
it's theatre.
But we are at risk of, we do know, and the Treasurer knows this, and good old Jim, I love him. I think he's a good guy and he's working his tail off to try to change things. He knows what's got to be done, but he's got to bring the people with him. That speech he gave to the press club, what was it, about a month ago now, he said, I've got to bring people with me. I can't just sort of from on high say, I know everything that I've got to repair. So that's sort of why he's got to consult the electorate. Yeah, he's not like that. He's got to consult the electorate. He's got to sort of bring them along. So if we're to change the tax system, if we're to do something on the GST, if we're to do something on negative gearing and capital gains tax, if we're to do some reform that cuts red tape that might cause that business to fail because they're relying on that red tape to keep them in business, well, sorry, mate, you're losing out. We've got to change this for the efficiency of the economy. That's where he's coming from. So, but Mark, these things are more long run. They're not going to change the economy tomorrow. Even if you had your magic wand today, it's not going to change the economy tomorrow. They take a while to permeate through the economy. Doesn't mean you don't do them. In fact, you do them faster, because the sooner you do them, the sooner you get the benefit.
Well, so I noticed the Prime Minister right this very day whilst you and I are recording this podcast is actually launching something today, actually, where he's calling on private enterprise, small business owners to do more for our economy. And prior to you coming in here, I had a couple in here who's just closed down their business. They're one of the statistics that we keep reading about in terms of they're not bankrupt, but they've closed a business down, business closing in Australia. And they're a New South Wales couple running a restaurant, hospitality, usual story. What do you think about the Prime Minister saying private enterprise, you're in private enterprise, you work for yourself.
Yeah.
You do more for the economy.
Yeah. I mean, doing what I can, mate. I can assure you. And so you doing the best I can.
And we're doing the best we can. I mean, our response might be back, well, that's a bit unrealistic, PM. I mean, is it like, what is it, mate? Is it taxes? Is it GST? What are we talking about here?
And look, it's a couple of those things, and I don't want to move away from the fact that we do have restrictive interest rates. Just by the way, I'm wondering if we did have an interest rate structure, which just goes back to that 50-point call that I've got, which won't happen, but I'm still going to make it. If we did have a lower interest rate structure, if the Reserve Bank moved rates lower, that's not the fix all of everything, but cyclically, as the cycle changes, it gives already the 2 rate cuts that we've seen. I know people think, thank God that's happened. Now, it doesn't mean they're going out and doing cartwheels down Pitt Street. Oh, I've back. Happy days are here again. But the sense of relief is obvious. Oh, my repayments have gone down a couple of $100. I'm still not going out. I'm still being very cautious with my money. But they're seeing the early stages of an improvement, let alone the small business sector. So the PM sort of saying we want the private sector to get out. Yes, we do. Business investment for 15 years has been shocking. That's one of the reasons we have bad productivity. Businesses have not been investing enough in technology, artificial intelligence, these sorts of things,
to allow productivity of the staff to be better.
Improve. Yes, correct.
Whereas the US and Germany, unbelievable.
Staggering. Yeah. In fact, in a lot of Asian economies, I've seen the things on YouTube or whatever of car manufacturing plants now. There's barely a human. Yeah. There's machines that are screwing on the wheels and the seats and the windscreens. A couple of humans working in a control panel.
Can you tell me what?
And how bloody good is that?
What Steve Koukoulas, tell me.
It's fantastic.
I mean, during the and I was only having this conversation with someone the other day.
Yeah.
And I saw Arthur Sinodinos, who was the
Arthur was Arthur.
He was the Minister for Industry, Innovation and Science under the Turnbull government, right?
Correct.
And after that under Morrison, as well.
Yep.
So Arthur now became the ambassador to the US, and now he's more in the consultancy industry. But the thing that we don't even have a minister for innovation anymore. There's no. Innovation is about what we're talking about here. In terms of productivity, we need more innovation, and we need businesses to be encouraged to do this more.
Risk takers, not ridiculous risk. But to take a risk, Mark, you took a risk with every business decision you take.
Still do.
You do. Of course you do. And not everyone's going to pay off.
Yeah.
They don't. But if you get most of them pay off, when they pay off, they do well.
Yeah.
That's good for the economy. And indeed, in a funny way, this is why you want businesses to start up. And if that idea doesn't come to fruition and change the way things work, that's okay. But we don't punish that the decision that didn't take off, for example, because the ones that do are fabulous. And again, just look at the US.
Particularly if they're in the innovation areas.
Innovation, technology, and the things, and this is the other thing about our economy too. We've got to remember, and this isn't going to change. We are not a manufacturing economy.
Yeah.
We've got a small manufacturing sector, and we'll never get a big one back again. And that's fine because people in Asia, in South America, Eastern Europe to some extent, produce things cheaper than we ever will, and it'd be silly if we tried to make them ourselves. We don't have the population and we don't have the structure of our economy. However, on services, Australian financial services are fantastic. Our superannuation industry, you mentioned before, we have got some of the best fund managers in the world who manage money for the big institutions around the world. So the BlackRocks and the State Street and these sort of people are using Australian fund managers because of their skills of managing money. That's one thing that's great. So, okay, is that innovative? Yeah, it can be because of the economies of scale. It's sort of, getting to Christopher's point the other day, people love Australia because it's a great place to holiday. So, yes, we're a tourist destination. Let's see if we can milk that for all it's worth. Because when a foreigner comes to Australia to have a holiday, they stay at a nice hotel. Let's charge them a fortune. They eat at our restaurants. Let's make money from them. They buy our lovely wine.
Every other country does it.
Yeah.
And go to Hong Kong, go to Singapore, go to America. They'll do it.
Of having tourism. In fact, it's great because it creates a whole lot of jobs across the spectrum. And in fact, many of them are quite labour intensive. At this stage, we don't have robots making up a room when you move out of your hotel room. You've still got to be a person that makes the beds and cleans and all that sort of stuff. So our structure of our economy, the point what I'm trying to say is that we are a services-based economy, which is very different to the mindset that we have to have manufacturing. And I'm still learning to overcome that because manufacturing's great. Yeah, we produce stuff and you can touch it. It's made, whereas a service, a financial service. So what's a financial service? What's tourism? What's sport? Education, things like that. So you get the best quality. Well, again, the universities in the UK and in America, the Harvards and the Oxford and Cambridge, whatever. Wow, who doesn't think they're the best university to send your kid to if they can humanly get in there? They're making a fortune from them. Fantastic. We've got great universities in Australia. Let's encourage that,
particularly for our Asian neighbours who love to come here
and pay full fees
because it's a safe country. Yep. It's a sort of integrated country. Yep. You're not going to get sort of stood down or stood out because you're not of a right colour or a right
correct
right religion or whatever. We're pretty tolerant in relation to those sorts of things.
Correct.
I mean, if I just look at one thing in particular, and you're talking about services. As I understand it, correct me if I'm wrong or tell me if I'm close, I think something like 80% of our GDP is services related and 20% is product.
Yes, and things like agriculture and other goods production.
Doesn't that tell you straight away?
Yeah, 80% services, mate. Yes.
So that's where we've got to concentrate and put our efforts into making those services more efficient. Have much more innovation and data-driven outcomes around this stuff,
and have a margin on it, make money from it too.
That's and make dough
and don't
charge for it,
and don't be shy about it.
Charge for it
because you're getting this service. Yes, it's good. So it's a little bit like a holiday. You think I've had a holiday, and just say I've spent 10 grand on a holiday. I've gone somewhere with the family. We've gone to a hotel. We've spent this money. You come back from that holiday. What have you got? Only memories and a few photos. So you spend 10 grand on furniture and a TV and a new kitchen. You've got goods to show for it. So that experience, it's experiences, if you like. Going to a concert, going to see Taylor Swift or going to the footy, getting a great seat at the football grand final and whatever. They're the experiences that people who can afford it love to spend their money on nowadays. They don't need another dining table. They've already got one. They don't need, the latest TV because the TV that they bought 2 years ago is pretty bloody good. They don't need to buy another new car because the one they got 2 years ago is also really good and it's going to run for another few years. What they do need or want is to go on a holiday. They do want to go to the footy grand final. They do want to go to a concert. They do want to do those experiences, walk along the Great Ocean Road, go on one of these hikes, fantastic. And to do them well, and the companies that are involved in ticketing, tourism, trekking, all those things are doing well. And that's where, we've got to be aware of where we've got to be careful not to sort of embrace manufacturing. I'm not being anti-manufacturing. In fact, the stuff that we do is really good. Manufacturing in, CSL with plasma and blood and medicines and things, fantastic. Our wine, I think wine's counted as manufacturing, not agriculture. Again, another really good business. We export tons of this stuff and, whatever. Not against them at all. In fact, in favour of them. If you're good at it, go for it. But don't discount the fact that someone having a holiday, spending $300 to see Taylor Swift, going to the NRL grand final, getting spending $1,000 on a glamping, a really nice camping trip where you stay at these nice, great.
So does that mean structurally the government has to change its emphasis? State governments, federal governments, and maybe local governments too for that matter, have to start to change their emphasis on how they market what we've actually got to each other, to ourselves.
I would.
And by the way, and how do we fix, but then, I know this is a bit off the topic, but how do we fix travel costs? It's cheaper to fly to Bali.
Yes.
And or my previous guest, he said it was cheaper to fly to Italy and stay there for 3 weeks.
Yeah.
Than it is to fly to Queensland or Melbourne and stay there for 5 nights.
Yeah, that's probably right. Yeah.
So, that's a structural...
How on earth does that happen? And this is something that the Assistant Treasurer, Andrew Lee, is on about, competition policy. We've had Virgin and Qantas on airfares. We had Rex that didn't make money, unfortunately, on the Sydney-Melbourne leg. They're still operating in other legs. I don't know how you get that competition in to be viable. It's something where, again, what's the barrier to entry? This is sort of getting into the nitty gritty of economics. I'm sorry, but what's the barrier to entry? So if a firm is making unreasonable profits, let's call it that. If
Qantas is making a lot of money, which is the case.
Yeah, and arguably they're ripping us off.
Yeah.
And
by the way, it's their job to do it.
Yeah, and if they get away with it, half their luck. I'm not being critical of them.
No, because that's their obligation, legal obligations to act in the best interest of the shareholders.
This afternoon,
Yep, you know what I'm saying? But it's the government's obligation also to say, okay, you're doing well enough. Yeah. We need to somehow encourage somebody else to come in and take you on.
And in fact, that's on the and maybe this can be more demonstrated on the international league. Whereas, it's only ever going to be bloody Virgin, Qantas, and maybe Rex or one other that might do the domestic legs. But internationally, Sydney to Europe, Sydney to America, Sydney to Asia, or Melbourne, the big cities.
Or
Brisbane,
Asia to Australia.
Whatever. Singapore Airlines, Cathay Pacific, all of the Middle Eastern airlines, Etihad, Emirates,
Turkish.
Qatar, Turkish, United out of the US, US Air, all these people. There's there's dozens of airlines that if we let them come in here, the only way that Qantas could get away with charging those excessive fares, well, they couldn't because Singapore would undercut them. Vietnam Airlines would undercut them. These other airlines would come in and undercut them if we go.
So we need structural change.
Open slather. No, not quite. Look, bugger it. Yeah, open slather. We need competition because, as you know, your brilliant market taking on the big financial institutions. You were at the forefront of embracing competition. You saw a market failure with Wizard and other things. You thought, well, these bastards are ripping off people. You got on there and you changed net interest margins on banks.
Yep.
So, by the way, thank you for that. And I'm not saying that to blow smoke up you or anything like that. But where there is a market, and how did that happen? And we'll go back to the reforms of the Keating years or Howard, whatever years. I can't remember what year all this started up. But because banks were protected before that because of the rules and regulations about the banking system.
It was Paul Keating introduced the Campbell Inquiry recommendations.
Yeah, and then along came Mark Bouris and thought, here's an opportunity to undercut this. So we need that in airlines.
It started off with government, though. It started off with courageous decisions by Keating. So the Campbell Inquiry was 1987, 1988.
Mid-80s, late 80s, yes, correct.
And Keating brought it in the mid-90s.
Yep.
He adopted it.
Yep, and away you go. And the banks who were lazy, I'll be blunt, back in the 80s, the banks were lazy, complacent. They had a net interest margin of 300 basis points. They were smug. 400 basis
Not
points.
now, but they were smug.
Oh, yeah, but then along came you and a whole bunch of others came along because they saw what you did first. And now net interest margin's under 200 basis points.
Yeah. Yeah, and by the way,
and they're still making money. By the way, look at the bank share prices
and making a fortune.
They're still making a fortune.
But there's an example.
We consumers, by the way, and the reason why this is important, it's not just because some economic theory that's a whole lot of crock. It's we as consumers are benefiting from greater competition in banks. Now, banks are easy to dislike, but I don't. I think banks provide an amazing service today. And they're so efficient, and the competition, you can tell me more than I can tell you, the competition in the banking sector is extreme. It's extreme.
It's very intense.
And the ability, so if you've got your mortgage with bank XYZ, and you think these other, they're offering 20 basis points lower, ring them up. They'll match it, or else you're going to lose a customer.
100%. And it's better to keep a customer.
Isn't that good for consumers? And that's what when I'm banging on about, we need more efficiency and productivity and cut red tape and recognise that we're a services economy. See, banks are a service. They're providing a service. They're providing an opportunity for me to borrow money to buy my house. And
by the way, it hasn't killed the banks. They're making a lot of money. And it's a very healthy industry. So,
yes.
We'll get on to the economy now, but this is part of the economy. So this summit they're holding, really, they just have to. No one has to come up with anything of genius. They just have to go back and say, okay, where have governments influenced structural change such that consumers do better?
Yeah.
We don't kill off the service provider, and where we made a courageous decision. And the best example, staring at them right in the face, comes from their very own, one of the greatest gods of the Labor Party is Paul Keating.
Yes.
Serious?
Yeah, no, he is. He's bloody fantastic. I love Paul Keating.
And Keating did this courageous thing back in the 90s.
Yep.
He did something else quite courageous, which is also now being attacked by the current government. He introduced a superannuation guarantee, which is like probably one of the globally recognised as one of the greatest pension building superannuation funds in the world. The rest of the world wants to look at what we do. Now we're tinkering. I mean, I'm not here to get political, but now we're tinkering with the superannuation. And I just think it's the silliest thing that we should ever do. I think we should be encouraging more money to go more superannuation and to be getting greater benefits out of the superannuation instead of sort of putting a lid on it. And I think we should be making those big courageous decisions about industries like transport, saying, okay, you two guys are making a fortune, the two big airlines, for example, I'm not trying to pick on the airlines, but we need to we're not going to affect you. You can compete. And they'll probably end up being as good as CBA is today. They'll probably make more money ultimately.
It's not telling these airlines or even the supermarkets. You remember the inquiring to supermarkets?
Insurance companies, supermarkets, telcos.
All that stuff. It's not telling them what to do, but it is getting rid of the impediments to a competitor to come in and say, hey, I'm going to undercut you. So you better lift your game. And if you don't lift your game, you're out, you know. So and of course they'll improve their service provision. And as consumers, we are the ones that benefit from that. It's not the government that benefits. Yeah. It's not the businesses. In fact, on the contrary, they've got to lift their game if they're to succeed. So they've got to introduce, and it's even in retailing, Mark. I remember.
But can I just stop you there? So what's really important for everybody to understand too, by the way, and because you made quite a good point then, the banks have to improve. So what our banks did, whether you like it or not, it didn't make sense to have branches anymore. They closed the branches down because the cost of income ratios were out of control. Yep. So, but they got very innovative in relation to digital.
Yes.
So you go along to CBA, and CBA's got an amazing app. ANZ's got an amazing app. Macquarie's they're all got amazing apps, okay?
My banking is all done on this.
Yeah. So the point being here, mate, is that they innovated in order to compete.
Technology, embracing technology. Correct. And so, in fact, this is what...
This is what we need to do.
I'm not a bank analyst, but this is an important point about that productivity issue. You mentioned that banks are still making lots of money, and
because they cut costs out.
Because you said the cost of me doing to the bank back in the day when I used to go into a branch, fill in a withdrawal form, give it to a teller, they'd type it in, they'd give me $100. What
you lined up,
whatever. The cost of providing me that $100 that I then spend on the weekend, whatever, was a fortune. Nowadays, I can get $100, click, 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 click. It costs them a microcent.
And it's faster for you and more convenient.
It's faster and more convenient. But the fact that there are literally billions of these transactions going on every year means that they still make money, but the efficiency is so powerful, the productivity is powerful. And again, I'll say it again, look at the bank share prices. Yeah. They're still paying dividends. Look at their P&L.
Mate, I remember CBA floated at $6.
It's now $180
in 1999.
Yep, $6. Imagine if you're still holding it.
That's what I'm saying. But that's been good for everybody. Yes, good for CBA. Good for CBA shareholdour good for consumers.
Good for superannuation holders.
Good for superannuation who have reinvested in CBA. So my point is, or our point is, government, if you're listening, don't be afraid to make the big calls that Keating made because someone's putting pressure on you from whoever it is, whichever entity that is, just still relying on the old school system because if you had never done that against the banks, we probably wouldn't have the innovation we have today, and you'd still be lining up a bank branch because the banks would never have felt any competition, never felt compelled then to change what they were doing because it's all working, and we'd be still lining up at the teller with their filling a little pink form out, as you remember, and
drawing out $100
and drawing $100.
And again, this is the other thing too.
That's an extreme example.
It is an extreme example, but it's true. It's a nice way of explaining it, I think, for our listeners here, because it does show, and even to the airlines. We'll go back to them for just 1 second. Nowadays you get your boarding pass on your phone. You don't click in and you check yourself in and all these other things. There are a few people at the airports, which is fine, but that automation is something that the airlines have embraced. You scan your card, so they don't have to print out these boarding passes that cost a fortune and all these other things. So the efficiency is very, very good. I mentioned retailing before, price gouging. So to the extent that and I don't think the big supermarkets are price gouging because, people do shop around. So there's Coles and Woolies and Aldi and the IGA stores and, we want more competition there. But at the end of the day, the share price of Woolworths and Coles is where it was 5 years ago. They're not price gouging. If they were making money, their share price would be booming. It's not. And so there's one example where perhaps they've taken what do we call it? A political easy target, because everyone goes to the supermarket. Oh, the price of my potatoes has gone up. Oh, the price of my washing powder's gone up and all this stuff. And people can see it, and that's fine. Yeah, we did have high inflation, as we've discussed. We did have high inflation. It did hurt. It was the consumer crunch that occurred. But that wasn't because they were ripping people off. That was because the price of buying that stuff,
the inputs,
went up.
Yeah.
Supply chain problems.
Yeah.
Cost of transportation was a problem. Anyway, that's just my...
We should go straight to our board now today.
Yes, definitely. We've got a lot to talk about, Mark, because the economy's rolling on still, or very slowly.
Right, Kookie. We're at the sharp end, mate.
We're at the sharp end indeed.
So everything right now is on the left-hand side as I look at it. So it's all on the tightening side. So you've got your categories. So what are we going to do?
So RBA meets next week. They have something. This is the Bouris Koukoulas version of the RBA board meeting, and they look at the components of the economy to see what's hot and what's not.
So just before we do go on that, and so we don't undersell the RBA. And I think it's important because we're being a bit, a bit cute with this. But it's sort of they're doing this, but they have, I think their model's called Martin.
Yes,
and they model like this is modeling, but we're just doing it in a physical sense. But they do it in a much more data-driven sense. We should just mention to everybody they just don't sit around. Having a cup of tea in Lamingtons.
Like we do.
Yeah, and throw things around. They actually are very technically biased, very data-driven biased, and it is not just what is the most recent data. It's extrapolating forward, extrapolating backwards, sensitivity analysis. They're saying, well, what if this, what if that, what if this, what if that, therefore what it looks like. Yep. So it's much. So maybe you could just give us a bit of an insight into that.
And Mark, thank you for saying that, because the bank has... Well, I think it's about 400 economists working for them. All of them are smart. To get a job at the RBA, you've got to be mighty good at economics.
Yep. And mathematics.
Yes.
And model building.
Correct. And so their models, which I think is the RBA governor and governors historically and other RBA officials said, they're the starting point of their deliberations. They have the models to look at the correlations between GDP and inflation, what's happening in the world and inflation, commodity prices, all of the interlinkages, and even half the stuff that we've just been talking about.
And if we do this could happen.
If we press on this button, what happens over here? And that's what they do as the starting point. And that churns out, I suppose is the word, their
recommendation,
unofficial forecasts and their recommendations. Then the Monetary Policy Board sits around the table and looks at these numbers, and then also hears the contribution, because the other thing that the RBA do, which is not model driven, they've got a business liaison program. So in each of the capital cities and regions, they go around, how's business? What are you doing? And they categorise in construction and retail and IT and whatever they are, finance.
So they're aware of all the bankruptcies and everything else.
Oh, indeed they are. And they ask people, what are you hearing? Because again, what you're hearing today will not be in the data for another couple of months.
So they're getting some real-time stuff.
So they get some real-time stuff that feed into the whole decision, and therefore we're going to cut rates or hold them steady or put them up, But the modelling is the backdrop and the support for what they do.
Yep.
And so but they have all of these components.
It's effectively that.
And a whole lot more. Yes, it's effectively this sort of stuff. This is why the monetary now they back in the day they used to have a monetary policy checklist.
Yeah.
They then got rid of it because it was too formulaic, if that's the right word, and they instead relied on the modelling. That's when, I think it was even Ian Macfarlane as governor. I'm going back.
Let's go back that far.
And then Glenn Stevens. They sort of maybe 20 odd years. They've always had models, but then they sort of changed their approach and got rid of the checklist and decided to adjust policy and assess monetary policy from a range of perspectives. But this is still relevant. And from my perspective, I'm not as smart as the people at the RBA. I need something like this to understand what is happening in the economy and where the pressures are, because each of these things is sensitive to interest rates. It is a hard data. We don't have the data on GDP, inflation, labour market. So we can sort of see, compared with what we used to, and this is this historical thing, as well as throwing forward, are we underperforming? And if we're underperforming, we need more rate cuts. If we're outperforming, if we're booming, we need rate hikes. It's as simple as that.
And it does go back to the simplicity of keeping us between 2 and 3% too.
Correct. And full employment and inflation between 2 and 3%.
Well,
correct.
Full employment as measured by unemployment.
Which is very hard to get a hard measure. But anyway, we've got our checklist
here, I just thought it was important to say that because I don't want anyone to think we're undermining the RBA because we don't.
No. And while we can debate their decisions, have they been too slow, too much, too little, too late, whatever, whatever. This is sort of like a if the RBA were ever to look at this exact board here, I think it would fit. They'd sort of say, yeah, that's actually not a bad way of explaining it.
Yeah, particularly for the point of view of our podcast, that is.
And for people to understand. In fact, Michelle Bullock's, in her term, well, she's been there almost 2 years now, coming up in September. Yeah, wow. She has been very, very good and trying very, very hard to make the RBA output understandable to the punters. And that's not being patronising because back in the day, you look at this sort of stuff and God, that's highly complex. And if it's complex to you and me, no wonder people can't understand what the Reserve Bank did. So she's trying to make it easy. So this is what we're trying to do too. We're trying to help the RBA
100%.
rather than hinder them.
Right, mate.
Okay, so going through our checklist here, GDP growth, as we said, 0.2% for the quarter, 1.3%. I'd be cutting rates, unambiguously. Inflation. Now, the Bureau of Statistics produced the monthly reading, which is a subset of the quarterly result. We do have the monthly reading up to May. In a few weeks' time, we get the June quarter
end of July
number, which is about 4 weeks away. But we already know that headline inflation is 2.1, near the bottom of the band. The trimmed mean in the May numbers, 2.4.
Best we've ever seen.
Best we've had for a long time. I'd cut rates because inflation's under control. It's yesterday's problem. Labour market, I'm putting in neutral because, as we discussed, we've got a 4.1 unemployment rate. That's pretty good compared with the last 50 years of history. There's some
pretty good, bloody good.
Bloody good. And there are still some anecdotes and some hard evidence from the NAB survey of labour shortages in some areas. So the labour market is tight in some areas. So we mentioned it in building and construction. If I want to find some tradies to fast track the construction of this dwelling, I can't find them or can't find enough of them at the right price.
Yeah.
So labour market's neutral. Wages, neutral as well. They're running at about 3.4%. We know that for a given product, this is where it gets a bit messy, and I don't mean to be messy on the podcast, but if we get wages at about between 3 and 3.5% annual increase, that's good. That's consistent with the inflation rate. We're at 3.4. We were at 3.2 the quarter before that, so we're at 3.5, give or take. We don't get the next wage number till the middle of August, so we've got to wait. That'll be a really interesting number, by the way. International economy, I'm putting between neutral and easing. We've got the Trump BBB legislation just went through at the time of our recording, basically. That's a stimulatory measure for the economy. And we know that Trump is sort of bagging Powell, why aren't you cutting more? Well, Powell's actually a little bit worried that this is stimulating the US economy. We had the non-farm payrolls last night. They were good. Unemployment back to 4.1. China's still weak, having said all that. Europe's muddling. UK is in trouble. The world economy is weak, but not catastrophically so. And most central banks are still cutting, although they're coming towards the end of their cutting cycle. So that's why I'm neutral to slight easing. I still think the Fed's got a few rate cuts to come, regardless of Mr. Trump, but it's on the easing side. House prices starting to pick up again. The rate cuts that we've seen.
This is your chance, mate.
Oh, look, the house prices are starting to pick up again because there's a shortage of housing. We're not building enough. Immigration's still strong. And that's why house prices are going back up.
Not because of interest rates.
Not because of interest rates.
Not because of affordability.
No. So if affordability was a problem, surely house prices would fall, wouldn't they? That's my rhetorical question to you. But look,
but I mean, as rates reduce, houses become more affordable.
Oh, yes, it does. The way that I'll spend 2 minutes on this because I heard Chris
Joy.
On your pod, Chris Joy, and he was adamant about it. And good on you, Chris. I don't think house prices are driven by interest rates. And what I'll do is I'll take a step back. If interest rates are unchanged, house prices are increased by about 5% per year, right? the cost of building, all that sort of stuff. When we've had I'll look at it from the perspective of rate hikes. Well, just in the recent cycle, from 2002 to the end of 2004, we had 425 points of rate hikes.
House price went up.
House prices went up. In Perth, they went up 37%. Why didn't interest rates work in Perth? I went back to 2002 to 2008. We had a whole lot of rate hikes. In that boom, we had a mining boom and rates went up. What happened to house prices in Melbourne and Sydney? Up 80%. Rates are going up. What happened? Shortage, cost of building, these sorts of things.
So it's just a basis of supply and demand.
Supply and demand and the cost of construction.
Yep. But what drives demand?
What drives demand? Oh, people. Household formation.
I know people do, but what drives the demand within a person?
Income, whether they've got a job. Labour market's important for the reason why the house prices are going up now is because the labour market's relatively tight, as we said just a moment ago too.
You and I agree on most things, but on this one, we're going to agree to disagree.
Okay, we'll agree to disagree. I'm writing a paper on that, and I'd love you to comment on it.
No, I definitely will.
Because
we're going to publish it.
I don't know. I'm writing it first, and I'm going to have a chat to a few people about where I want to put it. So it's going to be. I don't know if you read Alan Kohler's piece in the Monthly, or the Quarter, whatever that quarterly essay is that he wrote about a year ago on why house pricing's unaffordable. It was actually quite a good read. It was like 25,000 words. It was a mini book. Really interesting. I'm not sure whether I agree with all of his stuff too. So this is where the housing debate is.
Well, this is a typical of economists.
And it's healthy to disagree.
Economic science, rarely do scientists ever agree on anything.
Yep.
But that's the point.
And this is one that we don't.
And that's the whole point.
And that's what's so complex to fix it.
Yeah.
Because if
we can't agree,
myself excluded, if smart people can't work out what the problem is, how do you fix something that you don't know what the problem is?
I agree.
And if housing affordability is an issue, and I think that is an issue, that's what I do. We all agree.
Affordability is an issue.
And for young people and rental and all this sort of stuff. Anyway, we'll talk about that, and I'll show you a draft of my.
I'm looking forward to that.
Retail sales weak as water.
Still.
Consumers are hunkering down. Consumer sentiment, it's picked up a bit, but it's still well below neutral. So there are more pessimists than optimists. So I'd be cutting rates on the back of that. Building approvals. I'm going to put that in the negative side. We've had a dip back in building approvals in the last 3 to 4 months. We're not building enough. And while red tape, regulation, those sort of things are a constraint on new construction, so are interest rates. Lower interest rates will help our business home building numbers pick up. Business investment, putting that between neutral, it's not catastrophic, but it's, as we were saying, we want CapEx to improve our productivity. Yep. One way we're going to get that productivity better is if businesses, the private sector, as the Prime Minister said, invest in machinery, equipment, and people so that they produce things more efficiently.
And by the way, just on that, I mean, if I could just interject, I would like to see the government invest more money in making the employees that they put on in the various parts of governments to be much more efficient too. So I think capital investment, not just called business investment, called a capital investment by government, instead of just saying, we've got all these things we've got to fix, let's just put more people on. And who just end up working more hours, therefore becoming less productive to have the same outcome. I would like to see much more capital investment by government in making sure that the people they employ are much more efficient.
It's even things like public transport, or driverless trains and things like that. Really
so let's not just try and solve everything by people.
Yes.
Let's just try and solve, have some combination.
Is there a way that we can fix it with capital investment rather than just employing another 100 people on this job?
And I know it's outside of business investment. I'm talking about capital investment generally.
It's very, very relevant. Yeah, we need it across all sectors.
All sectors.
Private, public, and then retail, finance, tourism, everything, export industry, mining, everything.
Because when I heard the Prime Minister say that he wants businesses to take a greater role in our recovery at the moment, or our growth at the moment, I thought to myself, yeah, but you're out there employing, you're the biggest employer, had been the biggest growth in employment in this country for a couple of years. Yep. What have you done in terms of capital investment to make it you're more efficient instead of just trying to put more people out on it?
Yeah, and it even relates to some of the very big ticket items that we've got in our budget for the next 10 years, defence and things. It's not necessarily
that's a good example.
Just building submarines and missiles.
Yeah,
and I'm not a defence expert by any means. I reckon that our biggest threat is some sort of cyber attack.
100%.
It won't be they drop a bomb in Sydney Harbour or anything like that.
Well, they'll close things down.
It'll be a cyber attack on our banking, on our technology,
transport.
Yes. It'll be something along those lines that will be very painful. Anyway, so that's what we should be spending our defence money on, putting up barriers to that stuff. That's another issue. Business confidence, pretty ordinary, not catastrophic again, but erring on the side of easing. Global commodity prices, they're actually doing okay, so iron ore's still close to $100 a tonne. Oil's very volatile, but all the geopolitical issues there. But we don't have a commodities boom or a bust, so that's.
But in GDP terms, it's commodity prices are not doing anything.
Stock market, well, we're at record highs. I'll just put that in neutral, but maybe slightly there. But you don't hike interest rates because your stock market's doing well. If it's doing well because of low costs and the rest, that's right. And current interest rates, we said they're restrictive. So to get to neutral, we need to cut them to get to neutral. So we've got the red dots are overwhelmingly on the easing side or neutral side. There's almost nothing. Well, there is nothing in the tightening side.
So when I see this compared to previous periods, I think one of the things that our watchers and listeners need to understand, or maybe take from this, or if they could take from this, is that when the majority of stuff is an easing, or at least it's half an easing and half a neutral, they've got to look at that in the backdrop of where interest rates are currently. And currently interest rates right now are restrictive. So if you have a restrictive interest rates, but everything else, even if everything else was in neutral, you would still maybe think we should have a reduction.
And this is why I'm erring on, this is why I'm saying, I don't think it's the 50 basis points.
That won't happen.
No, it won't happen.
Well, they do two. They do one in July and one in August.
Yes, they've got another one in August, at the end of August, I think it is, and then another one in October.
And they'll have data coming out of July.
Correct. They'll have that very important CPI, the inflation number, at the end of July. And then we've got, of course, every monthly labour force numbers, really important for their deliberations. And as you can see, labour market's okay, good at the moment. It's very, very good. So, so that sort of goes into the rate cutting. So cut 25. It's one of those ones, what they say. We've had this cliche many times before. So what they say is just as important as what they do.
The language.
The governor, she'll give her press conference an hour after the decision is announced to the public. There'll be sort of 30 or 40 very eager journalists there to ask her and grill her questions, as they should. And she's done a brilliant job, frankly, in how she handles the journalists. And she's very honest. And I think she's a breath of fresh air into how central banking should be functioning. And again, it's not to say that we all agree with everything she says or doesn't say or whatever, but it's at least transparent. The RBA's deliberations are transparent. Think, well, actually, I don't think that that's right, but I can understand where you're coming from, and I think that's a really important part of RBA operations right now. So what she says, will she signal, well, here's 25, and if we get that low CPI, low inflation number at the end of July, if the next couple of employment numbers between now and our next meeting show unemployment at 4.3-ish%, we'll probably go again. And if they don't, well, then they'll pause.
I reckon she won't say that, though.
She won't say it in those words.
No.
She will say that we continually on the outlook for information that confirms that inflation's at the bottom half of our target range. Or Reserve Bank speak, which I haven't learnt to do.
But I think that where we are right now, I think we should sort of enjoy the moment, because we've been through a lot of interest rate increases. We are in pretty good territory, I think, data-wise, for seeing interest rates come down. And maybe you could just reflect quickly on what the money markets are saying, who have the best information.
Money markets who trade every day on these sort of things. We've got the money market pricing in about another 100 points of rate cuts between now and the middle of 2026. So over the next 12 months, roughly. We've got an official cash rate, currently 3.85, priced into 2.85, no lower. So we're not going back to where we were during the pandemic, no way. But we're getting sort of this range now that if we do see these 3 or 4 more rate cuts between now and this time next year, that's 75 or 100 points off mortgage rates. And then that'll be enough to breathe a sigh of relief. People will feel a bit of relief. And when we do have those rate cuts coming through, I'm sure retail spending will pick up. Consumer confidence will pick up. The builders will say, I can afford to build this property now. So we'll get some of these red dots, not moving towards a rate hike, no, but moving to neutral, which is sort of the
Goldilocks.
The Goldilocks, where we want to be. The Reserve Bank know that. And we also need to see too, just by the by, what the actual government delivers in terms of its reform agenda.
And then finally, Kooky, just one rap to the government. I don't give them many, but I'll give them one. If they can, and it's not the government, by the way, it's the RBA doing it, and us consumers, but if the government, under this government's leadership, if the RBA can land us at, consistently, close to 2.5% inflation and an unemployment number of 4.1, they've done a bloody good job.
If we are here in a year's time and we're at roughly 2.5 inflation, roughly 4 to 4.25, without picking the decimal point, low fours, let's call it. That'll be a great outcome.
For unemployment.
For unemployment rate, 4.1, 4.2, 4.0 unemployment rate.
And if we've had 3 rate reductions.
2.5. We've had the rate cuts. GDP's 2.5%, 2.75%. So we've got a bit of business investment coming back up because the private sector is spending on capex and those sort of things. Retail sales have picked up a bit because we consumers are breathing a sigh of relief on the rate cuts. That'll actually be pretty bloody good. We'll have a really good conversation if that happens.
Mate, 1 year ago, I think about a year ago, you and I threw up the proposition that it's all going to be even threes. So
yep, I remember that. Yes,
3 through 3. So it'd be really interesting if that we're going to get around that territory because, then we are really the lucky country. I mean, sure, inflation has gone backwards and prices haven't really gone reduced, but still we haven't had massive increases. I mean, right now we are not feeling the benefits of low inflation yet because
it takes a while to feed.
Because our incomes are going to sort of catch up to that cost of living increase we had, heavy cost of living increase we had during 2021, 22 and 23 and probably a little bit 24. So we haven't felt that yet. But in a low inflation, I say this to listeners to give them some confidence and some hope. We haven't really endured a low inflation rate period yet.
It's only been a couple of months.
Yeah, a couple of months, literally. And a low interest rate period yet.
It's only really just started. The first cut was in February, which is
we'll get it though. We'll get there
in May. And again, Mark, we've had this conversation too. An economy doesn't turn around in months.
It needs lead time.
It needs a year.
Yeah.
And so what you do today, the Reserve Bank or the government, whatever, does not impact on these dots for about a year.
And the good thing about this, though, is
started
2 years ago, mate, we're around the other way. We're looking at rate rises to bring everything into neutral from tightening.
Because we had high inflation, we had 3.4 unemployment rate. We had wages growth that was 4.5%. The international economy was booming. House prices are going up at 20%. All of almost all of these dots were in the tightening camp. And lo and behold, the RBA tightened. Yep, they did. But in a funny way, and this is the thing, and yes, I've been critical of the RBA, but if we're here in a year's time and we do have 2.5 inflation, plus or minus a few tenths, the labour market is at full employment and growth's happening, I'll eat some humble pie.
Same here. And I will say right now, I feel quite confident that I'll definitely give the RBA a rap.
Oh, yeah.
They took some courageous, but they did take some courageous moves.
That some of those last couple of rate hikes in 23 towards the middle. I can't remember the exact dates now. I thought, oh my God, what are they doing?
And you and I were critical, by the way.
We
that
were,
November rate, right? That November
2023.
We were critical. It didn't need to happen.
Yep. But that was one of the early ones of Michelle Bullock as governor. I think she just wanted to, and this is not a criticism, she wanted to impose her, stamp on, I'm a tough inflation fighter. And, well, maybe she was right.
Well, time will tell, but I'll dip my hat to him now, right now. So, because we're in a good position. So, mate, 25 basis points on, I think it's 8 July.
8 July, yes.
8 July. And then everyone should be looking out for the data comes out at the end of July.
Yep.
Really important CPI data. We'll get the quarterly and then we'll get the yearly for June. And, we're hoping it's going to be the same territory it's currently sitting in. I don't see any reason why it shouldn't be, to be frank with you, unless something crazy happens that we haven't been expecting. And then we'll see. And the next meeting after that, I think, is the 18th of August.
It's late August. Yes, I don't have the dates in front of me, but middle to late August. It might be the 18th. Yes,
I've got a feeling. I think it's the 18th of August, but
Oh, that's right. It is because we've got the wages numbers coming out then
Correct.
about the same time. Yes,
so we've got
yes.
2 RBA board meetings in the next 6 weeks.
Yep.
And I would expect, and I think you would agree with me, 2 rate reductions for a reduction each one.
If I was a betting person, that's where I'd have my money. And that's sort of, as we were saying, largely, not completely, but largely priced into the capital markets.
Correct.
Yep.
All right, mate. Good to see you, Kookie.
Thanks, Mark.
Well done, mate. And I'll be sending a copy of this to Joy Boy.
Thanks, mate. We should have a chat. Get him in here. Look, get him in here, Mark.
Mate, it's hard to get in.
I know.
You know how hard he was. He lives overseas.
Zurich or somewhere.
He's always around in Miami or wherever. He's got offices all around the world now. But it was hard enough getting him in just for that. But
if you can get him in, I'll crawl over broken glass to get here.
Put the two of you opposite each other.
And we'll talk.
Good on you, mate.
You can be the.
I'll be the mediator.
The judge. See you, mate.
Thanks, Cookie.